Hey everyone, Gavin here from Options Trading IQ, and today I'm going to share 4 specific stocks that I believe present compelling opportunities for selling puts and put spreads in 2026. Now, before anyone gets excited or worried, this is educational content, not financial advice. I'm a corporate authorised representative under an Australian financial services licence, and everything I share is for educational purposes only. You need to do your own research and make your own decisions. That said, what makes these 4 stocks interesting? Well, they've all experienced significant drawdowns recently, and if you understand how options work, you know that drawdowns often create the best opportunities for systematic put sellers, if the underlying business remains solid. Let me walk you through each of the 4 stocks, why I'm watching them, and how I'd think about selling puts or put spreads on each. Before we dive into the individual names, let me give you my framework. When I'm looking at stocks for put selling after a drawdown, I'm asking myself 3 questions. First, is the drawdown based on temporary concerns or permanent issues? If it's temporary headwinds, cyclical pressure, or a market overreaction, then that gets me interested. If the business model is broken, then I'm not interested. Second, what's the technical picture? Where are the support levels? What's the implied volatility like? Remember, we want elevated implied volatility to collect better premium, but we also want some technical support to give us confidence in our strike prices. Third, what's my risk management plan? And this is absolutely crucial. With puts and put spreads, I'm sticking to my standard position sizing of no more than 5% initial risk, and I'll never let a position grow beyond 10% of my account value, even after adjustments. For strike selection, I'm typically looking at the 25 to 35 delta range for put selling. That gives me a roughly 65 to 75% probability of profit at expiration, which fits my systematic approach. Now, let's get into the stocks. The first stock on my list is Netflix, and it's pulled back significantly from its highs, and I think this creates an exciting opportunity. Netflix hit all-time highs around $134 in mid-2025, but has since pulled back to around the $80 level, which is a 39% decline. Now, the concerns are slowing subscriber growth in saturated markets, increased competition, and questions about their content spending strategy. But here's the thing, Netflix is still a dominant streaming platform globally. They're generating positive free cash flow, as you can see here, very, very impressive numbers over the last few quarters. They've successfully cracked down on password sharing and monetized it, and their ad tier is gaining traction. This looks more like market digestion after a massive run, not a fundamental break. Remember, Netflix had a huge run in 2024 and 2025, and this is just the market digesting those gains and coming back to more reasonable valuation levels, in my opinion. The recent drawdown means that implied volatility is much higher than historical volatility. You can see here, volatility at the moment is massively overpriced relative to what the stock has done in terms of the historical volatility. More importantly, I believe Netflix will find support in the $70 to $80 range based on recent price action. Let's say you're happy to buy Netflix at $70 anytime between now and mid-June. You could look at selling the 70 strike put for around $2.65. And the delta on that is around 20, which means it's got a roughly 80% probability of expiring worthless. If I plug that into my cash secured put calculator, we can see we're potentially buying the stock for a 17% discount from where it's trading at today, or in other words, we've got a 17% decrease to our break even, and we're getting a potential 11% annualized return if the put expires worthless. Now, some people may prefer to go with a shorter days to expiration, which would result in a higher annualized return percentage, but you might have to accept a smaller decrease to the break-even price. Now, a cash secured put ties up quite a lot of capital, so we're going to have to set aside $7,000 to potentially take ownership of Netflix at that price, and that's pretty substantial. That's not going to be available for every trader, and that's where put spreads can make a lot of sense. Now, instead of just selling the 70 strike put, what we've done here is we've bought the 65 put as protection to turn it into a bull put spread. Now we've cut our risk to $400, so we can potentially do significantly more contracts and have less risk. If we're sticking with one contract, now we're only generating $100 in premium compared to $265. But like I said, we're only risking $400. We could easily do 3, 4, or even 5 contracts instead. Doing 5 contracts, we're actually generating significantly more premium. We're generating $500, and we've only got $2,000 at risk compared to the $7,000 of risk that we have with the cash secured put. Bull put spreads are much more capital efficient, but they still give you that same probability edge. And this is a trade that I'm actually entered this a couple of weeks ago, so I'll keep you posted on how it works out. The main risk with Netflix is event risk. So earnings can move the stock 10 to 15% sometimes. So if you're in a put position going into earnings, you need to be comfortable with that volatility and that risk. Also, if streaming competition intensifies or they lose pricing power, the narrative could shift quickly. But my take is Netflix is a quality business going through temporary headwinds. The premium is good. The risk reward for puts and put spreads in particular looks good for 2026. If you're enjoying the video, give it a quick thumbs up. I'd really appreciate it. And click subscribe if you haven't already. DraftKings is my second pick, and this one's interesting because it's been absolutely hammered lately. It peaked around 50 in early 2025 and has since collapsed to the mid-20s. There's concerns around sports betting regulation, increased competition from FanDuel and newer entrants, customer acquisition costs remaining stubbornly high, and questions about the path to sustained profitability. But if you take a big picture view, sports betting in the US is still in its early stages. DraftKings is one of the two dominant players alongside FanDuel, and they're gaining market share in key statistics. The current drawdown has been pretty severe. We're talking sort of 50% down from the highs. And that type of move typically inflates implied volatility, which means better premium for put sellers. And at these price levels, you're getting a much more reasonable valuation model. You can see here, implied volatility is the highest we've seen in the last year or so, very, very high, up at 75%, and well above the historical volatility, which is sitting at about 50. So very, very good value here for put sellers. That implied volatility is high, put premiums are elevated. This time we're going to look at a much shorter DTE trade. This time we're looking at the March $25 option. We can sell that one for about $1.37. You can see that really high volatility. Now, DraftKings does have earnings this week, so that is why the volatility is so high, and we need to be comfortable with that risk of selling puts before earnings. If we run the numbers through our calculator, we can see we're getting a pretty decent decrease to our break-even price, but a massive annualized return compared to our Netflix example. So that's partly because of the shorter DTE that increases our annualized return, but it's also because of the volatility, because DraftKings has much higher volatility than Netflix at the moment. But that's a pretty good decrease to our break even and a very nice annualized return potential if the stock stays above 25. If it goes below 25, we can take ownership at $25. We can turn it into a wheel trade from there. That would be my plan with this stock. I'm not currently in this trade, but I am looking at it and it is definitely on my radar. And we can see that because it's a lower price stock, cash secured puts in this case don't take as much capital. We can do this trade with only $2,500 of capital. And that's much more manageable for many retail traders with a smaller account. However, put spreads still make sense if you want to sell multiple contracts or manage your capital more efficiently. Here we're looking at the 25 to 22.5 put spread. We've got 5 contracts. We're generating close to $350 in premium, and we're only risking just over $900. So it's much more capital efficient than just selling naked puts, but they are a little bit more complicated to manage because you've got multiple legs. The main risk with DraftKings is that they're not profitable yet. You can see here they've still got negative earnings per share, even though it is improving. So you're effectively making a bet on their future profitability. There's also regulatory risk. If key states change their tax structures or betting laws, it could impact their business model. And it's a high beta stock as well, so it can move pretty violently, particularly with earnings coming up. We could see some big moves in the stock, so you have to be willing to hold through that volatility. It's not a blue chip dividend payer, but it is a good potential candidate for systematic put sellers who understand the risks. SoFi is my third stock, and this is one where I think the market has been particularly harsh. It peaked around $33 in late 2025 and has since dropped to around $21. There's concerns around rising interest rates impacting their lending business, questions about the credit quality of their loan book, new competition in fintech, and the broader sort of growth stock sell-off that we've been experiencing in the last few weeks. However, SoFi has actually made significant progress. They've achieved GAAP profitability, their member growth is strong, their banking charter gives them a funding advantage, and they're diversifying beyond just student loans into full financial services. You can see here they've actually started to get into positive earnings per share, which is great. They've also beaten Wall Street's earnings estimates in each of the last 4 quarters, so that's a great sign. At $21, SoFi is trading at levels that seem to price in a lot of bad news. Implied volatility is still very high at 60% because it's a growth stock in fintech. And again, that's going to mean large option premiums. This is the trade I'm currently in. I've sold the December 20 strike put. Now that's a very, very long-term position. That's kind of more my style. Sometimes I don't go this far out in time. I'd normally look at sort of the June expiration, maybe April or May sometimes, but every now and then I'll do really long-term trades. I'm happy taking ownership at $20 later in the year, and I'll just leave this trade sitting here doing its thing for the next 8 to 12 months. I definitely prefer slower moving trades that are much easier in terms of time management. And I don't want to get decision fatigue by, making lots of trades every week. So I want to be just doing the odd trade here and there, and particularly focusing on trades that don't take too much active management. If we look at the stats on this one, we can see we've got a potential 25% discount or 24% discount if we take ownership of the stock, because our strike price is at 20, the option price is at 380, our effective purchase price would be 1620, and that's if the stock comes down below 20. If it expires worthless, we're still getting a 27% annualized return, which is really nice. And we're only tying up $1,600 in capital, so it's a really feasible and available stock for smaller account holders who want to trade cash secured puts or the wheel. Now, that type of long-term trade may not be for everybody. The majority of people are going to probably prefer to use the March expiration, which is around 38 days to expiration. And we're still getting some really good premium there, $100 in premium and an effective purchase price of $19. If we compare the two trades side by side, you can see we're getting a much lower decrease to our break even, but still a good margin at 11%, not quite as good as 24%, but 11% decrease to our break even. And because it's a shorter term trade, we're getting a much higher annualized return of nearly 50%. Now that's assuming the put expires worthless. If it doesn't and it gets assigned, I would then turn this into a wheel trade. I'd potentially sell more puts below, maybe at 19 or 18, and I'd sell covered calls above 20. So this is a very accessible stock for cash secured puts, a bit like DraftKings. You only need a few $1,000s per contract, which makes it accessible for smaller account holders. Put spreads could also work great here as well if you want to limit the capital at risk. The risks are that SoFi is still a relatively young company with execution risk. If credit conditions deteriorate or their loan performance weakens, the stock could continue lower. They're also quite sensitive to interest rate movements. Both their funding costs and their asset yields are going to move with rates. And like DraftKings, this is a really high beta name. It's going to move a lot, potentially both on the upside and the downside. So you need to be comfortable with that volatility, and you need to size the position appropriately and be ready to manage if things go against you. But the opportunity here is that you're selling puts on a growing fintech platform that's already profitable and at prices that seem quite attractive. My fourth and final pick for 2026 is Robinhood. They had a really impressive run in 2025, going from the high 30s to 153. So it was only natural that they would experience a bit of a pullback here. And they've now dropped down to the mid 80s, and that's a pullback of around 46%. The concerns are mainly around crypto volatility impacting their revenue, competition from existing brokers, and questions about whether their revenue model is sustainable in a zero commission world. But here's what the bears are missing. Robinhood is actually quite profitable already. They're generating strong revenue from options trading, which I love. Their crypto business is a real differentiator from other brokers, and they've built one of the best mobile trading experiences in the industry. They're very popular with retail traders. The pullback from 153 to the mid 80s is significant because you're getting a 40 to 50% discount from the highs. And we can sell puts even lower to potentially get even more of a discount on the stock. And you can see here, they've got really nice earnings per share and they're continuing to increase. They have been increasing for a number of quarters here, which is great. The PE ratio has come down from the highs and it's still quite reasonable for a high growth stock. Implied volatility tends to be quite high on Robinhood because it's tied to market volatility and crypto volatility, and it's also a high beta name. Usually it trades between about 60 to 90% IV, which means really good option premiums. And here we can see the stock's trading at about 78% IV. This is the option that I've sold, the June 60 strike put. That's trading with 75% IV. I'm really happy to buy Robinhood at 60. We've got earnings this week. It could drop significantly. We'll wait and see. But I'm more than happy to take ownership at that 60 strike, which is a huge discount to that 153 that we saw late last year. Running the numbers through the calculator, you can see that that's a massive 35% discount from where it's trading today. And that's actually about a 63% discount from where it was trading last year when it was at 153. So that would be our effective purchase price if we're assigned at 60. So we've got a 34% margin for error on our trade, and we're still generating an attractive 17% annualized return if it expires worthless. Again, if you didn't want the unlimited risk of a cash secured put, you could easily turn this into a put spread by buying the 55 strike put. Now, Robinhood revenue is tied to trading activity and market volatility. If we enter a period where retail participation drops off, their revenue could take a hit. They're also heavily exposed to crypto, which adds another layer of volatility, and we've seen that recently in the recent sell-off. And there's always regulatory risk with any brokerage. Changes in the payment for order flow rules or any other regulation could impact their business model. But the thesis here is that options trading continues to grow. They're a popular broker with retail traders. Crypto is becoming more mainstream, and Robinhood maintains their position as a good mobile-first broker of choice for young investors. Now, before I wrap up, let me talk about position management because this is crucial. If you're selling puts or put spreads on any of these names, you need to stick to disciplined position sizing. My rule is no more than 5% initial risk on any single position. If I need to adjust, I won't let it grow beyond 10% of my total account value. For adjustments, my playbook is straightforward. If a put goes in the money and I still like the stock at that level, I'll take ownership and start the wheel trade. If I'm not ready to take ownership, I might roll down and out for a credit. With put spreads, your risk is defined, which I love. Your max loss is the width of the spread minus the credit collected, and that makes position sizing easier, and it helps with your sleep quality as well. And remember, I'm not married to these trades. If the thesis changes or the risk to reward shifts, I'm going to adjust or close. Focus on the process and the money will take care of itself. So there you have it, my top 4 stocks for selling puts and put spreads in 2026. Netflix, DraftKings, SoFi, and Robinhood. What do they all have in common? Well, they've had significant drawdowns, creating opportunity. They've got elevated IV for better premium, and they're quality underlying businesses that are going through temporary headwinds with reasonable support levels on their charts. I don't think these companies are going to zero. I think they're going to bounce at some point, and I'm happy taking ownership at even more of a discount from where they're trading at today. But let me be clear, this is not a recommendation to go out and sell puts on these stocks. This is my educational analysis based on my framework. You'd need to do your own research, understand your own risk tolerance, and make your own decisions. Every one of these stocks carries real risk. They could go lower, they can stay lower for longer than you expect. And if you don't manage your positions properly, you can lose money, even if you're right about the long-term direction of the stock. What I'm sharing is how I think about these opportunities from a systematic option selling perspective. The framework matters more than the specific stocks. You can apply this same approach to any stock or ETF that's had a drawdown. If you want to check out all of my trades from my long-term wheel trade on TLT, just click the link above. And there's also some other videos on put selling in the description below that you might want to check out. If you found this video helpful, hit the like button, subscribe if you haven't already, and drop a comment letting me know which of these 4 stocks you find most interesting, or if there are others that you think I should look at. Thanks for watching, and I'll see you in the next one.